Welcome to Capital Considerations. I'm Tony Roth, Chief Investment Officer of Wilmington Trust. It's been a pretty challenging stretch as we all try to make sense of what's happening in the markets and the broader economy. The headlines have been intense, and there's definitely a lot of uncertainty out there. On April 9th, we hosted a webinar where Lisa Roberts, Head of Wealth Management here at Wilmington Trust, sat down with myself, Luke Tilley, Chief Economist at M&T Bank and Wilmington Trust, and Wilmington Trust Chief Investment Strategist Meghan Shue. Lisa asked some important questions about how markets are reacting to the recent tariff news and where we think things might be headed for the U.S. economy. We want to share this conversation with you because we think it'll help add a little clarity as you navigate this market volatility. And don't forget to stay connected with your advisor. It's during times like these that having someone to help you stay grounded and focused on your long-term goals really counts.
Good afternoon, and thank you for joining today's webinar, New Tariffs, Big Consequences, Preparing for What's Ahead, from Wilmington Trust, a member of the M&T Bank family.
Hello, welcome, and good afternoon, everyone. I'm Lisa Roberts, Head of Wealth Management for Wilmington Trust, and thank you for joining us this afternoon for this very important discussion. And the last many days have been challenging as we navigate this particularly uneasy environment together. The headlines are driving fear, and many are bracing for further disruptions. And over the past many days, we've watched the markets react sharply to the announcement of new tariffs, triggering this wave of volatility, investor and business uncertainty, and broader questions about the global economy. And so today, we're going to break down the implications of these changes, explore the economic and geopolitical concerns, and what may lie ahead for the U.S. economy. And we are fortunate today to have with us our senior investment team to try to help us make sense out of all of this. So joining me are M&T and Wilmington Trust Chief Investment Officer Tony Roth, Chief Economist Luke Tilley, and Wilmington Trust Chief Investment Strategist Meghan Shue. And as always, we encourage you to stay connected with your advisor. We are here for you in the good times and in the bad times, and especially during uncertain times like we have here today. And we're going to help you navigate that volatility and keep your long-term goals in focus. So with that, Tony Roth, we're going to get right into it, and I'm going to hit you with the first question. So you've seen a lot in your investment career, but this feels like a uniquely unsettling time. At best, we are experiencing an unpredictable political environment with near zero visibility into what's going to come next. And at worst, we're at the very early stages of unwinding decades of globalization and geopolitical relationships. So my first question for you is, how do you see it, and what are you most focused on?
Thanks, Lisa, and good afternoon, everybody. So when I think about the last 30 years in the investment space, there's only a few analogies that feel like what we're experiencing right now. We have the tech wreck back in the late 90s. We had the great financial crisis, and we had the pandemic. And I would say that this has the potential to be of the same magnitude. Potential in terms of the economic outcomes of all those prior events were clearly recessions, potentially a deep recession in at least one of those cases. And we're at a moment right now where we're trying to calibrate and understand what's going on. We posted a blog post last week on the Wilmington Wire that Luke very aptly titled Slowly and Then Suddenly. And it seems like this has been an experience that's come on slowly and then all of a sudden very, very suddenly. And so when we think about what the administration is trying to engineer, the reason that we're sort of uncertain still is that we don't really know what their goals are. They haven't been really clear around what ultimately is most important to them. Is it that they want to collect revenue from tariffs in order to fund tax cuts? Is it that they want to bring manufacturing back onshore? Is it a sense of righteousness that they want to have a level playing field from a tariff standpoint? Or is it something else, perhaps? Until we really understand what they're trying to achieve, and by the way, some of the goals may be non-economic goals. They may want tariffs in order to negotiate non-economic points, and that's certainly something that has been talked about. And in fact, that was the beginning point of this narrative when tariffs initially went on Mexico and Canada in order to have an impact on fentanyl and immigration coming into the country. So there's a lot going on. There's a lot swirling around here. And we had a webinar about 3 weeks ago where we talked about whether the tariffs were tactical or strategic. And we still don't know the answer to that question. And that's really the key question that the markets are grappling with. What I will say is that there's no doubt in our minds that the U.S. is the principal beneficiary of the global liberalization of trade that we've experienced over the last 50 years. Certainly, China has benefited as well with tremendous manufacturing due to the consumption that the U.S. has had. But when you look at the wealth that's been created in the U.S. and you look at the kinds of jobs that have been created in the U.S., higher compensation service jobs, arguably more interesting jobs than being on a manufacturing line, we have greatly benefited overall from the liberalization of trade and the lowering of barriers around the world. And so when we look forward, we don't see this as a zero-sum situation. We see this as a situation where all parties lose if these tariffs don't come down. Now, that brings me, Lisa, to sort of the last aspect of my answer to this question, which is what are we focused on? What we're focused on, indeed, are these tariffs going to stay at the same level or will they come down? We feel pretty confident at this point that these tariffs are going to come down. There is a tremendous amount of pressure on the administration from small businesses, corporations, political constituents, such as the Ken Langones and Ken Griffins of the world, as well as the Bill Ackmans of the world, all these participants that have supported Trump that are all very, very exercised over these tariffs. And so I think that there's a lot of pressure on the administration to bring these tariffs down. And I think that they will come down to a large degree. Whether they come down enough to avoid the recession, we'll have to see. We think they're probably not going to come down enough and quickly enough to avoid a recession, but they will come down enough to avoid a deep recession. And that's what we're focused on most, is just to see to what degree these tariffs come down and over what period of time. And the last thing I will say is that the good news is that we're starting this episode with essentially a strong and healthy economy. Companies and consumers are in good shape. Balance sheets are in good shape. Profit margins are at record levels, frankly, or have been at record levels up until now. And so we have some room, if you will, to maneuver before we actually have that recession. And that gives the administration, I think, some time. And then last, I would be remiss to say that let's also keep in mind that there will be some benefits due to these tariffs. We will get more access to other countries for sure, their markets, and that will benefit the U.S. over the long term. So it's a big mix of things right now, and the immediate focus is to what degree do these tariffs come down and how long does that process take?
Yeah, thank you for that. And so you said a couple things in your comments. You talked about tariffs. We don't really know what the end game is. It could be a number of things, but we do firmly believe that they will come down. Is that going to come down soon enough for recession? Probably not. And then when you think about all these factors, and then the last one, right, is we're starting from a really good point, though, because the economy's been strong up to this point. So you're chair of the firm's investment committee, and obviously your team's been in constant dialogue about this situation, assessing it, evaluating the best next steps for a client's portfolio. So taking all these high-level things in consideration, what's the team considering in making investment decisions?
Well, I think first and foremost, Lisa, we're considering how fast the environment's moving. And as an indication of that, in the last 4 days, we've had a greater loss in stocks than we had even during the pandemic. You have to go back to the great financial crisis to find a 4-day period where stocks declined to the degree to which they did. And so, unfortunately, it's too late to sell in our view. It's also too early to buy. We're happy that earlier in the year, we made a number of changes to our positioning to move to neutral. And you can see from this slide that's up, we are indeed neutral across the board. It's the first and only time in my 11 years and my tenure as Chief Investment Officer here that we've been neutral across the board. And that reflects the degree of uncertainty that we have. I don't expect us to stay in that neutral position. I think that we are going to, at some point, understand where we're going from a tariff standpoint and be able to lean back into risky assets, which is where we like to be. And I also think that there's an opportunity to reevaluate the distribution of risk among risky assets, potentially moving into non-U.S. equities to a greater degree than we are in U.S. equities relative to our baseline portfolios. So all of that sort of needs to be understood in terms of a long-term view of a portfolio. right now, when we look at the volatility in markets and we look at the uncertainty that we have, yesterday we had a 7% swing in markets. We were up 3 or 4%, and then we were down 3 or 4% within a couple of hours. And so it's very, very risky to make big moves in portfolios when there's just so much incredible uncertainty, because let's face it, the administration could come out today and say that, oh, we've got a deal with Vietnam, and the market could go up 5%, or we could go 2 or 3 days without a deal. And with further silence on the part of the administration, that could push the markets in the other direction. And I don't think that long-term investors can afford to take the risk of missing those upside opportunities where you get so much concentrated returns in markets. What I do feel very strongly about is, as long-term investors, that we will get through this. Markets go up and markets go down. And I do believe that the administration is sensitive enough to the long-term economic prospects of the country and the impact that the tariffs are going to have on the negative side of the ledger in terms of the impact on small and large businesses, et cetera, that it will move to reduce these tariffs over time. And so we just need to be patient and to see over what period of time will that happen, and then eventually start moving back into risky assets.
No, I appreciate that very much, Tony. And, particularly in, I think, times like this. And look, we said at the beginning, this is something new, right? But we've been through this before, whether it was COVID, the Great Recession. We always manage through it at some point. And so keeping calm, less anxiousness. And as you said, like right now, it's too late to be thinking about selling. So this neutral allocation completely makes sense. So thank you for your perspective there. Luke, I'm going to pivot to you. It's been a whirlwind of information and reaction over the past week. So what is our view on the economy heading into those April 2nd tariff announcements, and how's that changed in light of the new tariffs?
Yeah, thank you, Lisa, and thank you for everybody who was able to join us. As Tony said, we published a piece on our website, the blog post on Wilmington Wire, where we moved our expectation for the U.S. economy to a recession this year with the probability of 60%. And that's taking into account a lot of factors. It brings in consumer spending, which I'll talk more about in a minute here, and then also business capital expenditures and a lot of the uncertainty that's at hand. But even before moving into that, this is a really hard thing, to call a recession. We don't actually have that many experiences with recession, let's say in the post-World War II period. Haven't been that many of them. They are all unique in terms of how you get there and the state of the economy going into them. So even as we talk about recession, we make clear in that post and want to make clear that we would expect it to be a fairly mild recession. We're talking about a couple quarters of decline in the economy. Shown here, it's the line is quarterly data measured in year over year, and then the bars are annual data. And you can see how the quarterly data sort of goes down and touches zero in a year over year sense, and then starts to resume growth. The annual number for 2025 even stays positive. So in an annual sense, the economy remains positive. But we see as these tariffs are going to hit the consumer and then also businesses, that pullback in spending by both. The other thing that I want to say about this call and this expectation of a recession is to put it in context. Tony said at the start that these things haven't happened that much in our careers. And I'll say again that all of them are different. We haven't had that much experience with a mild recession. At least it doesn't, stay that way in our minds of late. The COVID pandemic was different from anything we've had in a generation, of course, with the shutdowns of the economy. And then even going back to the recession, you would talk about the global financial crisis of 2008. That was a unique situation with the seizing up of credit markets. And so neither of those are really a good guide and a good thing to sort of keep in your mind in terms of how a recession feels when we talk about cutbacks in consumer spending and CapEx, because we're not expecting, at least for the moment, and we have not seen any indications that credit markets are seizing up, talking about this mild recession. And one of the reasons that we've moved this direction is the state of the consumer. And as we show on the next slide, the consumer has really weakened as we head into 2025. This is something that we had been saying, this is quarterly data, and then breaking down the components, the contribution to GDP as adding up to the total. And then that last bar is I'd say the most watched tracker of how the GDP number is going to come in. So we'll get this figure, the first quarter GDP, about 3 weeks from now. And until then, the Atlanta Fed has the best known tracker, and it does it by components. And at the end of last year, we had on net really strong consumer spending numbers. And anybody who watches our publications and watches that Wilmington Wire that's based on our website, you would see that even though we had strong consumer spending numbers in the third quarter and fourth quarter, it was looking to us like the consumer, it was a bit of a head fake. Like the consumer wasn't as strong as sort of those numbers advertised. It looked like there was a lot of replacement purchases in November for cars and a lot of durable goods for storms that had hit in the fall. And then December, it looked like people were getting ahead of tariffs. And then you can see the tracker on the far right there, a massive amount of imports. It leads that orange, that net export into negative, and that's sort of front loading to get ahead of tariffs. But the thing that we point out the most is that consumers have slowed down quite a bit even before we start to feel the impacts of those tariffs, that very small contribution that's expected as we go through January, February, and March here. And that's with a lot of data actually in hand. So as we look at this, and I think at the beginning of the year, even though the incoming president had talked about putting on some tariffs, we didn't expect them to be as big. That's one of the surprises. I think a lot of people and a lot of what the markets had priced in were that consumers were strong enough to handle them. And we thought the consumer was not as strong. And that's one of the reasons we've been sort of leery and dubious about consumer strength for the past couple of months. You couple that with the sheer size of these tariffs, and that's part of how we get to where we are. The second part, and this goes to business investment, is on the next slide, is that businesses are sort of challenged in terms of making a decision right now in order to make that expenditure for CapEx or to hire. And what we have here is a survey that's conducted. It used to be conducted by Duke University, and now it's administered by two of the Federal Reserve banks, asking businesses, so this is a survey of CFOs, businesses large and small, very large sample, asking them, how have your plans for 2025 changed in light of policies around immigration, corporate tax, regulatory? And a lot of the respondents will say, no, we haven't made any changes at all. But what this is showing is the proportion of companies who have said that they've increased or decreased their plans. And I'm not going to go through all of the numbers here, but what you take in is that sense of uncertainty that also shows up in academic research, not just in survey data, that businesses, when there's a lot of uncertainty about what's going to go forward, they have a tendency to sit back, not want to make the capital expenditures if they don't know what the playing field is going to look like, also not do that hiring. And that shows up here with the net negative numbers for the trade and tariff policy, for both capital spending and hiring, and sort of some mixed results for those other ones. So, Lisa, when it comes down to it, we see sort of that mixed response and the businesses sitting back, and then also the weakness of the consumer, and that gets us to our baseline view of that mild recession, Lisa.
Thank you for that, Luke. So we're seeing the consumers pull back, corporations pull back on capital expenditures as hiring. So we're calling for a mild recession, but I'm hearing short and shallow. So if it does happen, hopefully it is short and shallow. So I think most people have seen at least some of the information about the tariffs, but there's so many things to keep track of. We got Canada, we got China, Mexico, then delays. Now we've got steel, aluminum, autos, then the April 2nd announcement. So can you help everyone frame the size and impact of the tariffs in the context of the economy to help understand that scale?
Yeah, absolutely. And I think that this is something that really needs to be understood. How can you get to a recession when we're talking about tariffs? It's not even a major source of revenue. So it's two things. It's one, the sheer size of this, and then also that iterative way that we got to this, the gradually and then suddenly, as Tony mentioned, we used in the note, which is a Hemingway quote. And we're showing here the U.S. effective tax rate on the left-hand side going back to 1880. And this is an effective tax rate. So it's just, you have different levies on different goods. It's kind of like when you do your taxes and you get different tax rates on different types of income, different deductions and everything. And at the end you say, well, what was my effective tax rate? How much did I pay in tax? And how much did I make? This is the same sort of thing. It's how much did you collect in tariffs divided by how much did you import? And in the post-war period, and sort of that generation now that we've had that's been living in the relatively free trade, we headed into this with very, very low effective tariff rates, right around 3%. And then the diamonds there on the right are showing what happened on March 4th which was the announcements about Canada and Mexico and China. A couple of days later, announcing that few things from Canada and Mexico would be excluded. Those moved down. We could put in a lot of diamonds here, of course, as the news has come out. But as of April 2 last week, and now as of this morning with the higher tariff on China, that brings us to, and this is a very simple calculation, it's assuming trade does not change from 2024 totals. Kind of it's not a good assumption. We know that trade is going to change, but this is to scale it. We would move to a 24% effective tax rate, the highest since 1906. As of yesterday, before it would have been 19%, and then today with China's tariffs. And then to just give an idea of that scale and why it is such a large impact in the macro sense, the numbers on the far right, we do import a lot, 3.3 trillion over the course of 2024. And as we go down through and apply the tariffs across the countries and the different goods, we get, before any trade changes, almost $800 billion that would be generated here. And that's a significant amount of tariffs or taxes that would be paid. And then to scale it, it's very large. It's 2.7% of GDP, or if you compared it to retail sales, if you wanted to think of it in terms of those tariffs moving to retail sales and leading to some price increases there, 9.3% of total expenditure in retail sales in 2024. So hopefully that gives Lisa some sense of scale to everybody that's on today in thinking about how large these things are. And as we've discussed, if these get negotiated down, especially those very large numbers on some of our main trading partners, it could come down. But we're still looking at the impacts of what even would be lower rates on consumers, and then still that uncertainty on businesses. Lisa.
Hey, and Lisa and Luke, if I could just add one point before we go to Meghan. One of the things that is sometimes overlooked is the idea that these tariffs are not just a tax on the consumer, but they have a ripple effect through the economy. And so there was a really interesting article in the Wall Street Journal last week that dimensioned what happens with these imports that come into the country, and about 45% by value go into manufacturing, into other areas of the economy. And so what happens is, if you're a small business, as many small businesses do rely on supply chains outside of the country, you have a real problem, because either it has to come out of your profit or it has to come out of the consumer's pocketbook. And if the consumer's not willing to do that, then it comes out of your pocket. And if you're running your business at a small margin, then all of a sudden you're upside down. And so it's not just the tax on the consumer, but it's also the ripple effect through businesses that we have to be thinking about too.
Oh, I totally agree. There was a story last week. One of the major automakers was going to cease production in Mexico and Canada. Lots of jobs impacted, but then also their parts supplier in the U.S., and it's only 900 jobs. It's tragic for 900 people, but 900 people temporarily laid off. But then you have to think about the ripple effects of who they're getting their parts from, and then the drivers who would drive such parts and all those kind of things. And those ripple effects, as you point out, Tony, are incredibly important and also really hard to gauge and predict, which leads to the uncertainty. I totally agree.
Thank you both for that. And Luke, the chart says it all. The scale is massive. It's very significant, and the numbers there on the side. So appreciate that view. Okay, Meghan, I'm going to bring you in. And so my question for you is, so you surprised that the markets have reacted so violently? That's the only word I can think of, violently. And should we have expected this?
Yes and no. I would say yes, we should have expected this to some degree. And actually, we were pointing out since the beginning of the year that the market was priced very optimistically. And our capital markets forecast was really about chutes and ladders, and how in the immediate aftermath of the election, pretty much up until Inauguration Day, the market was focused a lot on the ladders and the good things, pro-business type of policies, not as much focused on tariffs, maybe thinking that these would be a second half of 2025 or even 2026 story. And as a result, when we came into the year, we were expecting, on the left, you can see earnings expectations from analysts for the S&P 500, very robust earnings growth priced into the market of about 13% for 2025. And the market was trading at a multiple on the right, a price to earnings ratio of about 22.5 times those forward earnings expectations. So robust earnings expectations and lofty valuations that they were putting on those sort of set us up for a bit of a rockier year. It was just a matter of what that catalyst would be. And then the catalyst that we got was, as you saw from the prior slide in Luke's discussion, much higher tariffs than anybody really expected, the higher than even the campaign proposals. I think was not really in too many people's bingo cards, and they thought that it would be more targeted, maybe more lead time. So when you think about the magnitude of the tariffs, the breadth of them, really leaving companies with no alternative other than back in the US, which is, probably part of the point. And then the timing of them, having them implemented right away, it just sort of paralyzes businesses and CEOs, and they don't really know how to adjust with that speed. But at the same time, I think the amount of volatility that we've seen in the market has been somewhat surprising. And Tony started off with a statistic about the 4-day drop in the market. We've also seen a tremendous amount of intra-day volatility. And if you look at the last 4 days, we've traded in a plus or minus 5% range within that day. And we've really only seen intraday volatility like that in past, sort of peak crisis type periods, 1987, 2008, 2020. It's not, we're not saying that we're going to go that route in terms of the market drawdown, but certainly the amount of panic as measured by a variety of indicators, including the VIX, a measure of equity market anticipated volatility, are definitely spiking to sort of panicky levels. From a strategist point of view, this might be a good thing. We're getting that flushing out of sentiment and maybe looking more attractive, especially for long-term investors, in terms of finding attractive entry points into the market today. The other thing that we are watching is what's happening in the bond market. That's been somewhat surprising. And just for anybody who's not quite following what's been happening in the past 24 to 48 hours, we've seen treasury yields increasing and value of bonds decreasing, which has some people very anxious about what that means. Obviously, we look for bonds as a defensive, protective part of the portfolio that is going to move inversely from equities and be a diversifier. And what we're seeing over the past couple of days is that stocks and bonds have been moving down together and not getting that diversification benefit. There's probably a lot of things at play, and we don't know exactly what's driving the market in real time. Certainly some concerns around stagflation and the stagflationary impact of tariffs, as well as maybe some loss of confidence in the US economic exceptionalism. We're also seeing interest rates in other parts of the world moving higher and maybe offering an attractive alternative to US Treasuries. And then there's what's happening in the market. We're watching hedge fund positioning getting squeezed, if you will, and something called a basis trade that might be basically just deleveraging of hedge fund positionings and bets that they have on in the Treasury market. I happen to think that the move that we're seeing in Treasury markets is probably more the last thing that I mentioned, and a little bit of just a self-fulfilling prophecy or negative spiral that you get in markets when you do have these deleveraging moments. But at this point, I wouldn't say that we're seeing any evidence of mass selling of US Treasuries from China or other trade partners, which I know is a concern. China has been steadily decreasing their ownership of US Treasuries for years. And it's possible there's some of that happening today, but I don't think that's what is driving the market in its entirety, Lisa.
Well, appreciate that on the treasuries, and hopefully that good news will stick. I think we've been talking about this for a while, though. We already were calling out frothy pricing and looking for some sort of correction, and the net message is the tariffs kind of exploded that impact. So thank you for the conversation there. So Tony, I'm going to come back to you, and this is on the Fed. They've been particularly mum right now, not really saying much. And so with that, I'm not sure anyone's feeling clear on how the Fed's going to react to all this. But what have they been saying, although it's been minimal, and what do we expect them to do?
Yeah, it's great question, Lisa. And they're so important in this ecosystem, of course. And we think about what the Fed is going to do with respect to inflation and interest rates, but also there are other critical role that the Fed plays in the ecosystem. Let me just start with the obvious one around the inflation and Fed funds rate question, which is, will the Fed cut rates to save the economy? Is there a Fed put? It's certainly not a Fed put. But in order to answer that question, we need to take a step back and remind ourselves that the predominant story in the markets over the last 2 years has been inflation. And we have largely, in our view, conquered the inflation mountain, not completely. Inflation is running a little under 3% now, not at the Fed's 2% target. And it's sort of plateaued for a little while here on the back of some of the events that we had last year, like the storms and the fires, et cetera. But we believe that when we look at all the data around the inflation, that it is continuing to come down gradually, and that shelter continues to be the largest force holding inflation up, but that too is coming down slowly. So we have a good backdrop for inflation. So that brings us to the current moment, which is when we look at these tariffs and the increases on prices that the tariffs will, of course, create to the extent that they are passed through and not taken as a hit to profits. Is that going to be considered inflationary by the Fed? And I think that the conventional wisdom from an academic standpoint, if you will, is that it should not be considered to be inflation because it's a one-time adjustment to cost. It's not a structural ongoing change that will cause prices to continue to go up. And indeed, if we look at what the Fed has said, the Fed initially did talk about inflation and that tariffs, in that non-academic way, where it was an increase to prices and therefore needed to be taken into account in its first order mandate, if you will, of balancing inflation and jobs. But more recently, the Fed has changed its tenor, and it said that, well, we can sort of look through these tariffs if we need to focus on what we often call the third rail of the Fed's mandate, which is growth. So sort of aligned with creating jobs. But if you have an economy that's really slowing down, the Fed is very aware of its role to potentially help the economy by going in and cutting rates. And if we look at the forecast for Fed funds rates, it is actually almost 50% that they're going to cut at the next meeting in May. So we definitely think that the Fed will cut if it needs to. We don't see inflation or even the increase in prices due to tariffs as a barrier to the Fed coming in and cutting rates. We still have a forecast this year for about 4 rate cuts, which is where the market is right now. If we have a recession, it would be more than that for sure, but we just have the probability weight the chances of recession or non-recession, et cetera. The other thing that I should say is that rest assured, I think this is important, that England had this so-called Liz Truss moment last year where the government wanted to essentially spend a lot more money than it had. And then the bond buyers stopped buying the British gilts and the interest rates went spiking upwards. And today, interestingly, there's been a lot of talk, is today going to be our Liz Truss moment? Or are we going to have a Liz Truss moment where the buyers of treasuries, as Meghan had mentioned, might lose confidence in the U.S. and stop buying treasuries? And there's a treasury auction at 1 o'clock today, so in about a half an hour. And there's concern, who's going to buy those treasuries? Will it be foreigners buying those treasuries? Institutions are stepping back due to the unwinding of the leverage in the basis trade that Meghan also referred to. The market seems pretty orderly today. We think this auction at 1 o'clock will probably be okay. But if not, what will happen is the Fed will step in and participate on the demand side of that auction to make sure we don't have a so-called failed auction, which is to say that they can't sell all their bonds, they being the Treasury. So the Fed plays a lot of roles beyond just setting interest rates, but we do think that as it relates to rates, they do stand ready and they are in position to cut rates if the economy slows to a point where we're going into a recession. And again, to Meghan's point, we started the year off with the chutes and ladders metaphor, and there are ladders. We're in the longest chute right now with the tariffs, but there are some ladders. Fed policy, some benefit from the tariffs and opening markets long-term, deregulation, et cetera. So, and maybe tax cuts. So there are some other things going on here that are going to provide some balance to these tariffs. We just don't know how much balance we need to stay out of recession because we don't know how difficult the tariffs are going to be.
Thank you for that, Tony. So probably some expected rate cuts coming up here. And depending on how 1 o'clock goes today or on any given day, we might see the Fed step in as there as well. So appreciate that. Meghan, I'm going to come back to you. So as we're talking about this economic framing, how are you thinking about market volatility? And what can you tell us about what's priced in?
Yeah, well, I think these times are really hard. Obviously, we're in a little bit of uncharted territory here. So what we tend to do is look at history. And what I find helpful is to look at past recessions. So let's say Luke is right. We have a recession. What have we seen historically? Well, we're plotting all of the basically post Great Depression recessions here, and the median drawdown, which is shown on the y-axis here for all of these recessions, is about, call it 25 to 30%. So I think if we're thinking about what's priced into the market, is it, are we finding a bottom here? If we're down about 20%, we're most of the way there. That's the good news. I think the other good news is that in that median recession, once you find that bottom, the time to recovery is less than a year. So, I mean, this is scary. It's very uncertain, certainly not fun to be watching markets gyrate as much as they are. But for anybody who has a time horizon of longer than a year, I think it is a time to be patient and to sort of ride through this. I think the important thing is really looking at the underlying fundamentals, and outside of a recession that is accompanied by essentially the popping of a bubble, which we don't see, you would expect one of these more moderate declines. Of course, it's hard to know. We are watching things like valuations, which have taken a hit. We showed that on the prior slide. Of course, earnings are really important, and we will kick off earnings season this week. I don't expect to learn a whole lot in terms of guidance from management, just because there's so little visibility. But it will be helpful to hear how companies are doing, how they're viewing this, any changes that they're trying to make. And then the other thing that we're watching in terms of what's priced into the market are credit spreads, which are essentially what companies here we're showing high yield, so below investment grade companies, what they have to pay to borrow in excess of US Treasuries. These spreads tend to blow out during recessions, and we're showing the last 3 recessions here. You can see the little uptick on the far right of this chart, which we were at very, very compressed levels. So again, somewhat expensive for valuations of this asset class. And now we've seen spreads move wider. By this measure, I would say we are not quite pricing a recession. We're maybe a third, maybe halfway there. So there could be some further pain to go in this part of the market, but this is also something that we're watching carefully.
Thank you for that. And thank you for the reminder that the average recession is 11 months. So again, short term. And if you're thinking about longer than that, then, which is most people, then we should be in great shape. So you also spoke about the differences in market drawdowns for the mild recessions versus these bubble scenarios. What are you seeing in the market side to support a more moderate drawdown in markets?
Yeah, one of the things that is encouraging is that we are looking at a little bit of cushion on the part of companies, specifically their balance sheets. Here we're showing corporate profit margins, which are down a bit from peaks, but are still very elevated relative to history. And there's a lot of reasons for this, but the bottom line is that with margins quite wide, we can possibly look for companies to absorb some of the disruption, possibly some of the increase in prices from tariffs. We are also looking at healthy household balance sheets, which for all of the headlines about credit card debt surpassing $2 trillion, if you normalize that by income, household balance sheets are also in relatively good shape. So again, to Tony's point and Luke's points about entering this period of uncertainty from a relatively solid economic standpoint, I think that is also helpful. We are also just not seeing other parts of the market that would indicate a bubble or excess, whether that's credit. So credit is not overly extended, though I showed the slide earlier indicating that we came into the market with high yield debt, a little bit expensive. And then there's tech. Some people have been very concerned about tech valuations. And I would say coming into this year, we were looking at more expensive valuations than maybe we were that could really get us excited, but not expecting this to be a bubble and actually see really solid earnings underneath the surface. So this is comparing the share of technology in the S&P 500 back in 2000, which was a bubble. And you can see from the teal bars that tech was about the same share of the index at that time. But today, which is the dark blue bars in terms of the earnings contribution to the index, tech is far out earning where it was in the tech bubble, generating about as much contribution to the index earnings as it is a share of the index at that 32%. So the earnings have been quite real. We are, it's not exactly clear who will be the ultimate winners when it comes to artificial intelligence and how this translates into the economy, but we are very encouraged from a long-term secular growth type of standpoint. And this actually might be, once we settle down a little bit, I think tech is going to be one of the first parts of the market to lead us back out of this.
Well, terrific news if you're a tech investor. So thank you for that. Again, in the long term. So, Tony, any final comments?
Yeah, Lisa, here's how I would end things. I think that we're going to be okay. It doesn't mean that we're not going to potentially have this recession. It doesn't mean that the market may not go down more. But I think that we have to remember that we're long-term investors and we are living within the most dynamic economy really in the history of the world. What I think that must happen, I think that it is happening and must happen going forward, is that the president talks about, I don't care anymore about the stock market. That'll do what it does, and I'm concerned about Main Street. And I don't think that that's really what's going on. I think that the stock market is really important for a couple of reasons. One is that people's wealth is tied to the stock market, those on this call, but also a lot of people on Main Street as well. And I think that when the market goes down very precipitously, it has a big shock on consumers, and it also is a tightening of financial conditions because people have less money to spend. So it's an effective tightening. People can't go out and spend as much. But the other thing that the market does, which is so important, and the same is true for the bond market, is that these markets are efficient and they reflect all the information that exists in the universe around what the outlook is for these companies or for the issuers of debt, if it's municipalities, so on and so forth. And so the fact that we've moved down about 15 or 20% on them from peak levels, and we're now sort of settling into this 5,000 level on the S&P, means that the market thinks that there's a possibility that we'll avoid recession or we could go back up, we could be okay. And so that dynamic between the administration and the market is so critical. If in fact the market starts to go down to the next level, which is, let's say, 4,400, and the administration doesn't react to that, then I think that it's a more concerning environment because the market is telling the administration it's losing confidence in our future. And I think that the administration, in fact, would react more strongly as we were to potentially incur more losses. And the market is saying instead, we're going to give you some time, administration, to reach some of these deals and try to work things out here. And so that dynamic between the administration and the market is very important. I think it's something the administration is very aware of. The market tells us a lot. And the fact that we're sort of taking a pause now at this level and the administration is very interested in negotiating. And they've made that very clear. I think that should provide us all with some reassurance that there's a good chance that we're going to come out of this okay.
Love it. And a reminder, we have been here before. And we always make it out. So appreciate the positive thought process there, Tony. As we wrap up, just remember that you do not have to navigate this uncertainty alone. And as you heard throughout the presentation, you heard words like patience. You heard words like the long term, the fact that we've been through these kinds of uncertainties before and have always prevailed. So staying connected is more important than ever. And your advisor is here to help you stay grounded and focused. And I would like to thank Tony and Meghan and Luke for sharing their perspectives, which are insightful as always. And we'll come back again at the 100-day mark of the administration and check in with all of you at that point. In the meantime, enjoy the rest of your afternoon. And thank you again for attending with us this afternoon.
This podcast is for educational purposes only and is not intended as an offer or solicitation for the sale of any financial product or service or recommendation or determination that any investment strategy is suitable for a specific investor. Investors should seek financial advice regarding the suitability of any investment strategy based on the investor's objectives, financial situation, and particular needs. The information on Wilmington Trust's capital considerations with Tony Roth has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. The opinions, estimates, and projections constitute the judgment of Wilmington Trust as of the date of this podcast and are subject to change without notice. The opinions of any guest on the Capital Considerations podcast who are not employed by Wilmington Trust or M&T Bank are their own and do not necessarily represent those of M&T Bank Corporate or any of its affiliates. Wilmington Trust is not authorized to and does not provide legal or tax advice. Our advice and recommendations provided to you is illustrative only and subject to the opinions and advice of your own attorney, tax advisor, or other professional advisor. Diversification does not ensure a profit or guarantee against a loss. There is no assurance that any investment strategy will be successful. Past performance cannot guarantee future results. Investing involves a risk, and you may incur a profit or a loss. Any reference to company names mentioned in the podcast should not be construed as investment advice or investment recommendations of those companies. Third-party trademarks and brands are the property of their respective owners. Third parties referenced herein are independent companies and are not affiliated with M&T Bank or Wilmington Trust. Listing them does not suggest a recommendation or endorsement by Wilmington Trust. Private market investments are only available to investors that meet the U.S. Securities and Exchange Commission's definition of qualified purchaser and accredited investor. Facts and views presented in this report have not been reviewed by and may not reflect information known to professionals in other business areas of Wilmington Trust or M&T Bank and may provide or seek to provide financial services to entities referred to in this report. M&T Bank and Wilmington Trust have established information barriers between their various business groups. As a result, M&T Bank and Wilmington Trust do not disclose certain client relationships or compensation received from such entities in their reports. Investment products are not insured by the FDIC or any other governmental agency, are not deposits of or other obligations of or guaranteed by Wilmington Trust, M&T Bank, or any other bank or entity, and are subject to risks including a possible loss of the principal amount invested. Wilmington Trust is a registered service mark used in connection with various fiduciary and non-fiduciary services offered by certain subsidiaries of M&T Bank Corporation, including, but not limited to, Manufacturers and Traders Trust Company, M&T Bank, Wilmington Trust Company, WTC, operating in Delaware only, Wilmington Trust N.A., WTNA, Wilmington Trust Investment Advisors, Inc., WTIA, Wilmington Funds Management Corporation, WFMC, Wilmington Trust Asset Management, LLC, WTAM, and Wilmington Trust Investment Management, LLC, WTIM. Such services include trustee, custodial, agency, investment management, and other services. International corporate and institutional services are offered through M&T Bank Corporation's international subsidiaries. Loans, credit cards, retail and business deposits, and other business and personal banking services and products are offered by M&T Bank, member FDIC. Copyright 2025, M&T Bank and its affiliates and subsidiaries. All rights reserved.